The market is no longer driven by fundamentals. It's driven by memes. Hey everyone, I'm Kyla, and I'm going to talk today about my thesis on meme markets. I'm not the first person to say this, but I just wanted to connect some dots that I've noticed and help to tell this broader meme market story. A meme, for context, is a behavior or style that becomes a fad and is spread by means of imitation from person to person within a culture. It originated by Richard Dawkins in his book, The Selfish Gene. And they've become a staple of our culture ever since. They drive how we interact and serve as these visual news sources and tools of navigation. We use them as methods to process the massive amount of information that we have to consume every single day. This broader meme movement has bled into the stock market. SPACs, NFTs, and GME are all real products that can be traded and have financial value, but at their core, they are memes. Right now we have this perfect storm in the markets where this meme market can take off. We have a combination of market enthusiasm, risk on sentiment, liquidity, and the meme markets where things don't feel as real as maybe they should. The big question is why is this happening and what's going on? The 6-part thesis. The market is no longer driven by fundamentals. It's driven by memes. No longer are memes a metaphor, but rather they are a living structure that is baked into the stock market. Part one of this thesis is SPACs. SPACs are an alternative to going public. Instead of doing an IPO, you can go public through a SPAC. SPACs have a lot more room to tell a story relative to IPOs. IPOs are normally conducted through a middleman, with underwriters interpreting the growth for investors. SPACs can capitalize on the softer regulatory constraints and speak to investors directly. The structure at a very high level is that an investor will pay a SPAC $10, and then the SPAC is going to pool all of the investors' $10 together into a trust account. The SPAC then has X number of years to take a company public. If they're successful and they take a company public, the investor has two options at that point. They can buy new shares or they can redeem. Redemption is where hedge funds tend to make a lot of money, primarily because they got in early. They're able to capitalize on that early bird pricing. Big issue of dilution. And SPACs are really interesting because they're this mystery box IPO. And that's fascinating people who are looking for something to be fascinated by. With the mystery box, it can be anything. It can be EV, AI, robots, terraforming, vertical farming, and that's new and that's exciting. And that excitement is reflected in the broader market movement. In 2019, 59 SPACs raised $13.6 billion. In 2020, it was 248 SPACs and $83 billion. In March of 2021, we're already at more than 250 SPACs, raising well north of 2020 numbers and making up more than 70% of the IPO market. The SEC actually had to step in and warn against people joining a SPAC because so many celebrities were forming their own, and they had to remind people, hey, listen here. Hype and performance are not positively correlated. Performance is not hype. SPACs are shells. They raise money with the hope to buy a company. So investors are truly investing in hope, more so than a usual pre-revenue tech investment. And the connection to memes here is that memes are visual narratives. And so SPACs are essentially investable memes. Going beyond the mechanics of a SPAC, there's the influences too. The important thing to remember is that SPACs are tools. They're financially engineered products. And as tools, they can be multi-purposed. Their primary purpose can be to shift risk rather than to serve as a pure investment opportunity. There's risk reallocation. Sometimes the SPACs can be used to pay down debt, and that shifts the risk of the levered SPAC and the loan investor to the equity investor. Then there's the supply and demand issue, right? The basic principles of supply and demand is that if you have a SPAC, you need to SPAC a company. There are about 400 SPACs on the hunt for target companies right now. You have so many people going after potentially so few companies. That means that potentially bad companies can get SPACed. That's not good. That's bad. You don't want bad companies going to market and having investors invest in them. There's also sponsor incentives. SPACs are pretty popular because it's an easy way to get paid as a sponsor. They earn about 20% of the equity independent on deal outcome. Sponsor incentives are very high. It's very profitable to SPAC correctly. It seems like a pretty cool thing for hedge funds, right? A risk-free way to get exposure to a potentially high-returning investment opportunity. In post-deal, the owners of the SPAC are left holding what are hopefully the remnants, or hopefully it's an intact company that they're holding. This gets into Elon Musk and the Tesla effect, because a lot of these SPACs are EV companies. The idea of a Tesla effect is that any EV business is worth a Tesla. There was a really good article in the Wall Street Journal that talked about how it took Google 8 years to reach 10 billion in sales, the fastest ever for a US startup. But in this current SPAC frenzy, there's EV companies that are planning to beat that record. They're in the same industry. There's only so many people who want to buy an EV, but they all think that they're going to beat Google in this 10 billion sales goal. And more than 10 EV companies have been valued north of $1 billion before producing any revenue. All right. As SEC wisely stated, hype is not the same thing as performance. Elon himself is an embodiment of this meme market. Elon is very successful, and what he envisions is extremely powerful. But renaming himself Techno King of Tesla, his association with Doge, his 420 share price target for Tesla, tweeting about Etsy, tweeting about GameStop, he knows his power. He's created billions of dollars in meme value. He has so much power in the markets. Knowing that you can just tweet one word and people will move markets accordingly, I think a lot of people would envy that. But the thing is, Elon doesn't create fundamentals, he tweets. And the market cap of Twitter, the poor Twitter, it reflects the trillions of dollars that have been generated from within its platform. There's a really interesting research paper that addresses the mispricing of SPACs through the lens of this Tesla effect. Many mispriced SPACs in 2020 were linked to electric vehicle-related businesses, this Tesla effect, raising concerns on whether investors even understood what they were buying. Because investors were associating them with Tesla and Elon and assigning an arbitrary dollar sign to that, simply by association. But there's a lot of things that need to shake out in that market moving forward. In the EV market, there are headwinds of US legislative and regulatory efficiency, the limited availability of lithium, and issues with hydrogen fuel cells. There's a lot of money headed that way. But SPACs trade on hope. They don't trade on fundamentals. And so SPACs are investable memes. Memification implies understanding. If we know enough to meme it, that means that we can distill it down and process it. But with SPACs, they aren't understood. The dilution process is complicated. The valuations are ridiculous. And when SPACs fall, they fall pretty hard. So SPACs in Tesla, more or less, are driven by these meme markets. Tesla bleeds into ARK Invest, which is Cathie Wood and her company. That's been another beneficiary of this meme market. I respect Cathie greatly. I think that what she has built is incredible. I respect people who have visions, and I think she has a vision, but I'm talking just pure fundamentals right now. ARK owns a lot of Tesla. The funds have about a 10% exposure to Tesla. Tesla owns a lot of Bitcoin, and through Square and Grayscale, ARK has even more exposure to Bitcoin. When Bitcoin price drops, or when any of the prices move across the board, there's potentially this ugly forced selling dynamic, which causes pain not only in Tesla, Bitcoin, and the ARK funds, but also in the biotech stocks that ARK is currently a whale in. You've got a feedback loop, and that is risky. They highlight some of this risk in some of their disclosures, but they don't really have a ton of notation around it. ARK now owns more than 10% of 39 companies. There's also an affiliated fund, Miko Asset Management, who, when combined, the two own more than 25% of at least 3 businesses. And together, they control 20% or more of an additional 10 companies. This sort of concentration is fine in a high growth environment, and it's working now because liquidity is out from the Fed and there's stimulus. ARK benefits from that. A rising tide lifts all boats, as they say. But you got the here doing its thing, and that puts pressure on tech valuations, and ARK has a lot of exposure here. These high-flying companies are valued on cash flows 10 to 20 years in the future. They're vulnerable to rising rates, hypothetically, and if their valuations compress, that could be very bad for ARK and the investors who own ARK. In risk periods, correlations converge towards one anyway. But with ARK, you do have this magnification of concentration risk, correlation, and illiquidity too. ARK really benefits from the concept of reflexivity, where the rising prices attract more investors, and that's a cycle within itself. Reflexivity shows up in another meme byproduct, NFTs. NFTs are non-fungible tokens. With money, each dollar bill is the same, but with art, no painting is exactly like another. Same with trading pieces, books, etc. NFTs are meant to capture some of that uniqueness. The value to NFTs comes in three parts. The first part is ownership and authenticity. They're digital assets, a crypto token on the blockchain. It's a key to a particular address on the blockchain. NFTs are a noun, not a verb. They point to the asset. They are not the asset themselves. It points to the asset that you have NFT'd. It pointer. Really, it's this pointer. The second part of NFTs is abstraction. Money isn't real. And Santiago said this really well. Money is just an abstraction of value. Art is an abstraction of emotion. Digital assets are an abstraction of code. And NFTs are an abstraction of all three. Finally, with NFTs, it's about purpose. And Santiago again, it's not about the merits of the medium, but rather the merits of the talent. Just because it's not a painting doesn't mean it's not art. But the concerns here are that there's worries of sustainability and energy use, and it's pretty unsustainable, and it does need to be contained. With NFTs, they've been frothed up into everyone should NFT something. If you don't have an NFT on the blockchain, you're missing out. It's this mix of FOMO and memification, with people NFTing absolutely ridiculous things, but also they're NFTing beautiful works of art. That's the hard part about memes. They're inherently clever and valuable in disseminating information to people, but the market is frothy, and the heat itself makes the kitchen hard to be in. This is coincidental, but the fact that People's Peace ended at 69 million felt very meta. NFTs will likely be around in some iteration as we continue to rethink online property rights, but there are so many factors in the market that are driving people to this point of memes becoming living structures. This is where GameStop comes in, Jimmy. When Hertz declares bankruptcy in May, over 140,000 Robinhood traders added it to their portfolio, causing the share of the stock to spike by over 1,000%. They did the same thing with Kodak. Then GameStop happened. There's three things here. The pandemic was an exogenous shock. The stimulus package was a liquidity inflow amongst a sheer lack of consumption opportunities. There was also collective coordination due to information access. Keynes said it best when he said markets can remain irrational longer than you can stay solvent. With GameStop, that's the exact situation. It was really four main players. You had Wall Street Bets, and within that umbrella was DFV, and then you had the hedge funds, then you had the brokerage firms, and then you had public figures. DFV has been posting his GameStop trades for a very long time. Michael Burry of The Big Short announced that he was long GameStop back in 2019. In 2021, Ryan Cohen joined the board. This perfect storm was created. Wall Street Bets is this great example of the growth of retail trading. It's a place for people to talk about trading and to post memes. They meme the market, and they pay attention to hedge funds. Hedge funds have a strategy called short selling, where they make a trade expecting the price of a company to go down. Wall Street Bets noticed that hedge funds were short GameStop, almost comically short, 140% share short, meaning that they were short more shares than were even available. Well, why don't we just squeeze that? There was this coordinated move to push the price higher. This is called a short squeeze. What happened next was something called a gamma squeeze. The stock began to go up in price, and option buying resulted in the stock price going even higher. A lot of people started buying call options to gamma squeeze and to push the stock price even higher by manipulating the middlemen, the market makers. The idea is that buying a ton of options forces the market makers, the middlemen, to hedge their own exposure by buying the stock of the underlying company. And the hedging of the stock resulted in the stock price going even higher. Then a lot of stuff happened. Robinhood halted trading, and that was very bad. The main thing was that this volatility resulted in higher collateral, so the brokerages really didn't have a choice. There were potential liquidity, solvency concerns, and they had to protect their financial positions. But people thought that the brokers were shutting down to protect the shorts. Then the payment for order flow came up, where the middlemen pay to access these trades and execute upon them. People don't like that. Then Elon, the meme kings, both Strachey and me and several people spoke out against Robinhood and other brokerages. GameStop still being traded. Vlad and Ron and Kitty both testified, but nobody knows what's going to happen quite yet. That was the peak of the memification. That was the memification of the entire industry. The whole thing was take back the power, anti-establishment movement. I think it's impressive, but it's still this broader meme narrative that bubbled up into a massive meme. It was more than just a meme of a stock or posting something in a Reddit forum. It was a collective takedown. It brought to light a lot of the inefficiencies and holes in the market. It also showed how divorced we are from fundamentals. This gets into retail investors and the role that retail investors play in the market. Retail investors account for about a quarter of all value traded, which is up from about 10% a year ago. Crypto is a leading indicator here, with retail leading the way of institutions. Investors are primarily concentrated in speculative assets. Robinhood has added over 6 million users in the past 2 months. And call option volume is at all-time highs as people try to figure out what money actually means and how to use it and how to make it. You have accessibility to margin debt, you have information, you have online brokers, and you have low commissions. That creates this perfect storm for retail investors to step in and to trade. The Fed has a communication problem because they can't front run stuff anymore. Things are already baked in. The 10-year is moving no matter what they say. And institutions have an information problem too. This is from a research paper. Despite their negligible share of 0.2% of the market, we find that Robinhood traders account for over 10% of the cross-sectional variation in stock returns during the second quarter of 2020. We have so much information about so many things that the gatekeeping of the industry doesn't make sense anymore. Institutions still have a lot of power. Bill Ackman's CDS trade is a great example of this. But now, Wall Street Bets is here. The retail investor is here. And whether that be a fluke or not, it shows the structure of the market and how it can change. There are several variables that I will be keeping an eye on. Earnings numbers, there's a big gap between non-GAAP and non-GAAP and GAAP profits as the adjusted for the pandemic numbers begin to shake out, and it'll be important to discern what non-GAAP actually means. I'm watching the energy market really closely. The 5 super majors generated about 20 billion in FCF, but they rewarded their shareholders with about 50 billion in dividends and share buybacks, so keeping a close eye on those guys. The Fed and foreign buyers can keep the long end of the treasury curve down, really important in determining what's going to happen with yields. The Fed has been pretty patient. Foreign buyers have been pretty quiet. Also the 10-year. The markets are pricing in a lot more than what the Fed is talking about. Also going to watch the Treasury General account and what Yellen does there. She's planning to reduce the TGA from 1.6 trillion to about 800 billion and then to 500 billion by the end of June. So that'll be a lot of liquidity hitting the market. The idea that the financial industry is the gatekeeper to this ivory tower of money isn't as accurate as it used to be. SPACs, NFTs, and GameStop, it's all people testing the limits, and they're memifying things, sure, but it's also reimagining how we make money. The creator economy is something that's real, and people are increasingly wanting to work for themselves and be their own boss. Memification is a function of information access broadly. The market is fueled by meme access. And this is a broader sociological phenomenon, but meme markets show the growing power of the retail investor as well as the structural cracks in our market. To borrow from Dawkins here, our meme complexes are going strong. The market is no longer driven by fundamentals, but rather driven by memes. Memes a metaphor, but rather they are a living structure that is reflected into the stock market. Thank you for watching. I will be posting more of these, and if you like this, please give it a thumbs up, and if you're interested, subscribe. I love talking about this stuff. If you want to reach out and chat, you can find me on Twitter, you can find me on TikTok, and yeah, I appreciate your time. Thank you. I hope you enjoyed it.